on Friday. It's a noon hour. And you know what that means. That means Finance Friday with your host, me, Robert Morales, RCO Network, along with my co-host, Francisco Ayala from Coleridge Group. Hey, say hello, Francisco.
Hello, hello.
And back at it again this week, we have from Sacramento, California. Please welcome our other guest host, Sacramento Satoshi, my brother Henry. There he goes.
Hello.
Yeah, we're back at it. So every Friday we come at you here on Finance Friday, talk about your finances, talk about the things that make the world turn a little bit. And my music got cut off short, but that's okay because we're live. So if you have any comments or questions, go ahead and put those in the comments section below. If you like what you're seeing, give us a little love, little heart, little thumbs up helps too. If you're on YouTube, subscribe because you want to hear the content and things we got going on every week. So please welcome back everybody here. Hello. Say hello, everybody.
Hello, hello. Next time, I want to be the one that says, like, hello, hello, welcome to the show. I want to use my broadcaster voice.
Well, you need the mics. Hello.
Yeah,
so like you get really deep in these mics, and you get to project yourself in a very different way.
That's what I want to do. Yeah, I want your job.
Well, come on in.
You got to go in the studio for that.
Yeah.
Yeah, come into the studio. We got all the sounds and crevices and everything that got going on. Anyway, we're here to talk about finances, not about your voice, even though it's very sexy, senor. Yes. No. Anyway,
yes.
So we were talking before the show today a little bit about things that are happening, and I think we're going to take a little bit different direction in the way we provide information. So, talking to Frank, talking to Henry, I think what this show, with the intent of this show, is to really connect with you guys as an audience and everybody watching, just to kind of give an outlet and a place to kind of have a dialogue and discussion about, my personal finances. I guess I can be the test subject because I'm very curious about a lot of these things. And where I'm at in life is I want to learn more, and before we started this show, I was really, I would say, ignorant towards finances and, plugging my money into just different things. I would go from one meme to another. I'd go from one news story to another, and the funny thing is I guess I'm bringing it up early. So if we bring up stuff like Bitcoin, that's been on the news so much lately. It's like, we should be seeing the information that we're getting from Bitcoin is like, hey, everybody's investing here. Maybe I should go put my money here. But I would say something like Bitcoin is getting just as much news as like gold is because they're comparing those things. And it's not getting the same kind of traction or the same kind of, the reactions we're getting, especially from Bitcoin. So there's just so much news and so many things that are about money and finance that I would say I'm confused. And I need a little direction. And again, the intention of the show is that we provide that direction for you guys. So
Yeah.
Frank here and my brother.
I think what we want to do, at least what I want to do, because I am a financial advisor and I've been working with this for quite a few years now. Yeah. If somebody wants to reach out and work personally, that's fine. I would love to help you guys. But why I'm here in the show is to build a sense of community with people that want to know about this stuff. I want to know about other things. I want to know about my physical health. I want to know about spirituality, and I look for other resources to be able to do that. I go to different YouTube channels and things like that. Well, I want this to be a place where people can come and learn a little bit about personal finance, right? How they can improve their lives incrementally, little by little, in the world of personal finance. So that's really kind of why I like being here, and hopefully I can answer any question that you guys have.
Henry? Why are you here, Henry? Why do you want to bring?
Why am I here? Good question. I don't know. Because you're my brother, and I can help you.
He wants a voice too. He wants to be on the show too. Have a voice. He's actually going to be here in October.
I think a great benefit of having Satoshi here is that he is a savvy individual investor, probably a lot more savvy than than your typical person that's kind of getting started and stuff like that. And so I'm coming out of a lot of this from a financial advisor perspective, right? But Henry can help us kind of give the individual perspective of how he went. And I don't know if you worked with a financial advisor or not, Henry, but how you went to kind of make your decisions, learning and stuff like that on your own, and in case you're not going to work with a financial advisor or things like that.
Yeah, I mean, so early on when I first started making money, I did work with a financial advisor. And uh, I don't want to say the negatives of it, but let's just say I did got some education. One of the big things that she taught me was that you have to think of yourself as a business. And just like any business, if you have a good CEO or bad CEO, you can grow that business or you can destroy it. And so it just made me want to learn more, just like you're saying, we can all learn more. And how do I grow my business or my home or my net worth or whatever you want to call it, so that I can because most people when they start off, they are basically exchanging their time for money. You go to a job so that you can get money and pay the bills. And it's very difficult to get ahead like that. And the reason that is because uh, we can talk about inflation or assets. Assets grow at an exponential rate. And so if you look at something that goes one, two, three, four, five, six, seven, eight, versus something that's growing exponentially, it's 1, 2, 4, 8, 16, 32, 64, 128. So one person has 8,000, another has 128,000. Over time, if you let that asset grow at an exponential rate, you end up with more money, and it's hard to get ahead unless you can accumulate those assets. And I think one of the things that people, they always think in a linear fashion. I think it's hard for people to kind of think in an exponential, as far as time is an exponential. I think like COVID is one example of an exponential rate. You see COVID coming out, and there's a few cases here and there, but it's like I don't know anybody who has COVID. You tend to dismiss it until it gains traction. All of a sudden, there's 10,000 cases, 100,000 cases, a million, and then it just
Right.
explodes.
Yeah.
And I think,
And so,
I think the difference in this whole thing, you were in a position, and without getting into too much personal, as well as I think I'm in that same position where you're allowed extra time to kind of get involved and be a little bit more active in your finances, and that's where a lot of your perspective has come from. It's come from exposing yourself and having the time to. Where Frank is in it 24/7. That's what he does as a career. I do it because I am. Well, for the show, obviously. But I want to learn more, and I do have that little extra time to invest and understand that. But us reaching out to this community and us trying to build this, it's I guess it's designed for those people that don't have that time, who don't have a position that they can kind of take that extra time because they're bogged down with kids, they're bogged down with a 9 to 5. They're bogged down with like just normal stuff that prior to because I've known you forever.
Yeah.
Prior to having this time,
Literal.
we were just caught up in the day to day and never really gave us or I guess allowed ourselves to have that time. And so for this show, in the terms of the show, we want to have a resource for people to come and connect with us, and then obviously get some information that they wouldn't normally get, at least from a genuine source.
well, and also I would say, I mean, now you know me, and you know that I work maybe 2 days a week, so yeah, I do have a lot of time. But I didn't start off that way. The reason when I first started working, I was working full time, and you have to make those decisions. And again, you don't see the rewards right away. It takes a long time. So this like get rich. How do I get rich real quick so I can have a lot of time? That's really just not going to happen. You have to kind of work and figure out, okay, how am I gonna build my assets so that I have assets, and then I can use those assets to do other things, and
Yeah.
it snowballs itself so that now I can pay off my house. Okay, now I have enough money, I can invest in a home. Now my investment home grew, and I can lend it out. Now I can use that money that people are paying me in rent to buy more stocks. And then pretty soon it's like, you know what? I can just cut down to halftime.
Well, it's
I don't have to
interesting.
work every
It's
day.
interesting that you
And
bring
that's
up.
what people, that's,
Yeah.
go ahead.
I was going to say it's interesting bringing up asset allocation because that's what Frank and I were talking about before. designing your intentions and trying to figure out what do you want to do short term, long term in your investments. And Frank brought up the idea of asset allocation. I asked him, what that was. And so, do you want to fill in with that, Frank, and kind of lop off?
Yeah, let me just go back 1 minute. But yeah, so basically what you guys are saying is being intentional. Being intentional with your work is definitely being intentional with your life, and being intentional with your assets, for sure. That's kind of the whole point, right, of doing this. And it's going to be slow process in any regard, whether it's in your personal life, whether it's your work, whether it's your investments. It's a slow process to get started, but then the compounding effect, as Henry said, is it really starts taking a life of its own, and then you're a lot better for it. But so what we're trying to do is we're trying to bring a lot of the things that we've talked about in the weeks before and try to bring it down to the personal level. How can somebody that's listening, that's viewing right now, use it in their personal financial decisions? Asset allocation being one of them, because you hear this term, you should know your asset allocation and asset allocation this, and your employer, your 401k. Well, what asset allocation do you want? And you're like, what the hell is that? What asset allocation is really is what percent of your investments are going to be allocated to a certain asset classes, right? What percent of your assets are going to be in stock? What percent are going to be in real estate and bonds and things like that? And so that's all it is what percent of your, whether you're looking at your liquid assets or your entire portfolio, including, physical real estate and stuff like that, what percent is going to be in what? And what we have to be intentional about is that you choose it, right? That you choose the asset allocation. If you say, I want, because of your analysis, because of working with a financial advisor, however you looked at model portfolios at Vanguard, you said, somebody that, kind of my situation, I want a 70-30, 70% in stocks, 30% in bonds. Well, that's fine. That's your asset allocation. You were intentional about it. But the reverse is true also, in that if you don't intentionally select an asset allocation, you still have one. Okay, you still have one. You just haven't selected it intentionally. It might be 95% cash, 5% bonds, but that's because you didn't do anything about it, right? And so you still have an asset allocation. The difference is that one of them is intentional, the other one is not intentional, and so be careful that you know what it is and why it's that way.
And what drives me crazy, I think, at the end of this is like when people say, I don't have enough money to set aside for, investing. I don't have enough money because I have to pay for this, pay for that. But it's those same people that go and buy, a TV on credit, that go and buy, alcohol or weed and say, I need this. This is just for me. But that little bit of money could be set aside for something. And, we talked about Robinhood, and even those accounts or whatever it is, Coinbase, it doesn't matter. You can add and continue to add small amounts of your income into these places instead of, sending that. We just choose to be, I think, sometimes in our position. And if there was a takeaway, and I think if there was a significant takeaway between everybody that's on here, we're all from the same small town. We all grew up in Douglas. And we all I want to get to my brother's level where he's only working 2 days a week and, managing his,
Me too. Damn.
live in Sacramento. I mean, I would like that too. I want the Satoshi lifestyle, and I'm getting there, I'm still building my business, and doing it a little bit different way, but it's all kind of the same emotions, all the same thing. You set aside money and you put it in and allocate and grow it. It's all developed that way. And then again, if there was a testament, you want to get to a point, where Satoshi's at.
I think, and so moving on from investments, asset allocation into another very important part of personal finance, which is a cash flow statement. Or you can call it the income statement. You can call it a budget. I don't care what the hell you call it, but it's basically the same thing. And I can venture to guess, Henry, that you, when you were starting your career, were very intentional about your budget, about your cash flow, how much money you were going to set aside for saving, how much money you're going to set aside for as an emergency fund, how much money. The people that win financially are very intentional about everything, not just their investments, not just, it's everything. And it starts, the cash flow is the heartbeat of a financial plan, because there is, you kind of start directing your money to where you want to go. How much money am I going to save? How much money am I going to use to pay off debt so that I can pay it off quicker? How much money, can I afford to eat out and travel and stuff like that? What do you say, Henry, about being very intentional about the cash flow statement or budget or whatever you want to call it.
I think, yeah. So I think those are going to be, if you know nothing about finance and you're saying, you know what, I want to learn. I think, you just start reading. You can read. I think one of the first books I read was Finance for Dummies. You just start reading, and yes, you have. It's just like I said. If you have a business and you don't know where's the money coming from and where's the money going, then what are you doing? You're just then. This is just a joke. Then you're just like the federal government. You're just spending money, and I'll worry about it later. No, I'm just kidding. But
you gotta watch those words. They get dinged on YouTube.
Oh, great! Now we're gonna get hacked.
Answer here, man.
I've gotten so many dings and emails saying, "Hey, your YouTube video has been flagged."
Okay, sorry about that. Sorry about that, federal government. But anyway,
oh boy,
so
no politics.
Yeah, so you got to do a budget because you have to. You got to know what are you spending your money on? How much money is coming in? Do I need Disney, Netflix, Spotify, Disney Plus, and Hulu? I mean, or you know what I mean?
Right.
Where's the money? Where's the money going? How do I? And then you have to ask yourself, how can I get more money? What can I trim? And then also, I think looking at I always look at like your net worth, looking at your net worth, because that's basically what you're trying to do. You got to know how much am I worth, and the whole goal is to increase that. And yes, there is, there's the asset out what you invest in, but then there's also what you owe. Your net worth is basically what you own minus what you owe.
Yeah.
And so, in a lot of times, if you have credit card, like this is just an easy one. If you have credit card debt, what is the interest rate? I mean, that's before you start investing and trying to make 10%, you can make 18% by just paying off your credit card.
Right.
And so that's an easy way to start. And once you kind of, and I don't think, I'm not one of those people that thinks that, okay, all debt is bad. There's some people like the Dave Ramsey's, or you got to get rid of all debt. I'm really not on that spectrum, but and I do have debt, but my debt is like at 1% or 2%. And so in that case, instead of paying that off, I rather take the money and try to make more than that.
Right.
But that's usually, yeah. So that's basically the basics is to do a budget, take all your bills. I mean, we have credit cards now, and it's easy to look at your credit card statement and they'll break it down for the whole year. This is what you spent on restaurants. This is what you spent on going out. The banks kind of make it easy for you to look at all that stuff.
And just to kind of, finish here, because we don't want to make the show solely about the budget, but that's where it starts. That's where it starts. That's where financial success starts. Is your cash, I call it cash flow statement. That's where it starts. If you can't get that shit under control, you're never going to win at money, no matter how much money you make, because it's just going to there's holes everywhere, and you're not going to be able to, invest the adequate amount and stuff like that. So that's where it starts. So if listeners are not willing to spend some time and learn about that fundamental piece of financial, personal finance 101, then they should really have no business in looking beyond, and looking at investments and looking at Bitcoin and looking at any other stuff.
Yeah.
Right. You want to get that under control so that then you can invest in then you can invest in the assets and then start growing it. Because just think of this as a game, and that's how you win the game. It's not that difficult, but it does take some, maybe you need a second job. Maybe you need to read.
Take some patience and time.
Yeah, and some people aren't motivated. They're like, I don't want to read. Then you're not going to win. I don't know what else to tell you.
So we're about the 10-minute mark. So we have about 10 minutes left. So if you want to leave your comments or questions, like what you're seeing, and want to comment, ask any questions from the Satosh, from Finance Friday Frank. He's triple F. He's double S. I'm just Robert. So if you have any questions, go ahead and put those in the comment section. If you like what you're seeing, give us a little love, just a little heart emoji, and go from there. Yeah, so we appreciate it. And so if you want to tune in every week, we're here every week talking about these sort of things. But coming from, and I cut that up. Coming from again, 3 people from a small town. To be when we were growing up, Henry, because we grew up in the same house practically. He's just 5 years more than I. growing up from the same house, we had a father and a mom that just went to work. They worked, and my dad collected his pension, and is like, hey, son, you gotta work your whole life, and you gotta get a job that has a pension, and and then you retire. And that was it. That was just a very simple, wasn't very business minded. And when he finally passed, didn't really have a whole nest egg. I think when he passed, he had roughly 25,000, and that's not a lot of money. I mean, in the short term, sure, it's a lot of money. You can go buy a car with that, but in the long run, like, how do you retire on that? If you basically follow, like, if you retire at 65 and you're on average die around 78, there's a good 13-year spread there. 13 years, and how are you gonna survive on $25,000 for 13 years? That's not really realistic, And that's I guess the focal point and things that I wanted to bring up in today's show is that getting into these things and starting off takes initially knowledge, and at least I would say even a little bit further back, and wanting to learn more, the desire to just start to learn and not just be so passive about things, and if that means reaching out to Frank, if that means reaching out to me, if that means reaching out to Satoshi, I mean, whatever it is, start that process. And I don't know what the challenge is sometimes for people to reach out and at least take that first step or dip their toes in the water.
Yeah. And I mean, there's a lot of people you can ask, there's a lot of resources, but I would just caution everybody, and probably Henry, you would probably do the same, is caution anybody that's going to say you can get rich pretty quickly, right? It doesn't take a lot of time. As we just said right now, it takes time, initially. First, but once the compounding effect starts going, man, think about it. You have $10,000. The market's up 20%. Now you have $12,000. You have $100,000.
I was going to say we have a comment, so good if you want to finish your idea.
Yeah. So basically, you have $10,000, market's up 20%, as it was, probably last year, I think it was up 20% or something like that. Now you have $12,000, $2,000 gain. Well, now that person with the $100,000, the market is up 20%, same 20% for everybody. Everybody participated 20%. Now that account is worth $120,000. So investor A, $2,000 gain, investor B, $20,000 gain, and you can kind of go from there, right? Investor C with $1 million, he just made $200,000. Everybody got the same return, 20%, but somebody made $2,000, somebody made $20,000, and somebody made $200,000. That's how compounding works, and so, yeah, it takes time, but it works.
So we have two comments from the same person.
Yes,
so
nice.
Henry, you might know this person, Claudia. Which would you guys recommend paying off first between two credit cards? 1, smaller balance, higher interest, or 2, higher balance, lower interest? That's the first question. Stumped everybody.
Be careful here, because as a financial advisor, I cannot really give particular financial advice. I'm just going to speak hypothetically. Okay, mathematically is going to be. This is kind of from the Dave Ramsey theme that I actually personally agree with. Mathematically, it makes sense to pay the higher interest credit card first, obviously. Mathematically, that's a no-brainer.
Yep.
But we are not wired that way. We're wired with emotions, and we have to realize that. And by paying off the smaller credit card first, there's going to be something inside of you that is going to feel proud, that is going to feel accomplished, and it's going to motivate you to do the other one and the other one. And so what Dave Ramsey recommends, obviously, because it's pretty popular, is start with a small balance and then keep on going. It's to gain momentum. I personally agree with that. Now, if you know that you have the emotional fortitude and blah blah blah, rational investor, then yeah, go ahead and pay off the higher interest rate first. But if you need that motivation, if you want to feel accomplished, and that's how I am. That's the approach personally that I took. I started with the smallest one, and I did that one, and then the next one. And it feels so good, because that's how we're wired. We're wired to act by our emotions, not rationally. Okay, although it makes sense to act rationally, we're wired to act emotionally, and so that's my advice.
Yeah, so if you want to reach out, we're just entertainers on this show, by the way. We're not financial advisors, Frank is, but you have to talk to him offline. On this show,
And
we're just entertainers.
I agree with Frank. You have to just take emotion out of it, and it's hard to know if you don't know the balances. But just so you can do it yourself, look at each account. Which one is draining more money out of your account? Is one costing you $300 in interest a month, and the other one $150? Then you pay off the one that's draining you $300. It's just a matter of math, but it's hard to answer if I don't see the numbers.
Yeah, right. I mean, so just take your balance, multiply it by your interest rate. That's how much interest, if you would be paying, just again, if you add more, it changes if you start adding more and stuff like that. But do the math of how much interest you're paying on that thing, and that will give you the rational, the rational way to do it. But we're not rational. We're driven by emotion. And so maybe just getting some momentum, paying off the small one quickly, that would probably make more sense.
Yeah, and then I will also branch that with, if it's personal debt, I leverage off of my business debt too. So I have a business line of credit, which I can take certain tax deductions for. So there's certain things, especially if you have your own business or create your own business, there's certain tax advantages you can use and leverage off of that, and use it as long as it's for business purposes. Use it for your business and have that as a write-up. So you can actually use it to your advantage when you take out debt against, let's say, a business versus a personal. But we have one more question, and this is probably more for the Satosh. What's your take on investing in crypto?
What's my take?
Let's see. It has to be brief. We're coming to the end of the show, sir.
Okay.
Got 3 minutes.
So I like crypto. I think you should. But also you have to know it comes with some risk. And so again, you got to look at for me. So for me personally, I look at my net worth and then I say, okay, this is what I have. And without disclosing number, I probably have like 50% invested in stocks. I have like 40% invested in real estate, and I have like maybe 5% invested in bonds, and then I have 3% invested in crypto. So as a fraction of my total net worth, it is pretty small, but it's still a significant amount, and that's just because it's a little bit on the risky side. I think crypto is still very early. And the reason I'm a bull on it is because I believe that it's it's an inflation play. And so what we're talking about, the reason you have your assets compound over time is because of inflation. And so let's say, for example, if you had $20 in 1980, you could buy a whole basket of groceries. And 20 years later, in 2000, you could maybe buy a half a basket. And today, maybe $20 will get you like a few items at the grocery store. And that's because of inflation. It's devaluing of the currency. And if you look at Bitcoin, 10 years ago, Bitcoin would get you a basket of groceries. Today, it will buy you a car. And in 10 years, maybe it will buy you a house. And so that's why if you just look at household income from 2009 till a couple years ago, I think household income tripled, and then the last year it almost doubled, and that's because of the money flow that's going into the system. And so whenever you do that, that's why. So if you look at your property. And the government will say, okay, inflation is only 2%. But if you look at like real estate, my real estate has gone up probably 50% in the last 3 years. So that's more like 15% inflation, not really 2. Yeah, now they're saying, I think they just admitted it. It's more like 5. But
well, and a lot of these things, as you invest, it's unrealized gain until you actually cash out. So that's I think the other tricky part is like you can go to the water cooler, you hear like how somebody made $10,000. Because they put in money in Bitcoin, but they really didn't make it until they actually cash out at that price. And it's kind of interesting
Right.
that you went back to knowing your percentages, because that's where we started the show, and that's where Frank was kind of drawing us to, is knowing your asset allocation and knowing where your money's going to. And for Claudia's question, a small percentage of that went to Bitcoin. And I know Frank
Yeah,
wanted to say something.
just real quick. I mean, so obviously another topic, fundamental topic to particularly investing is diversification, right? And so, yeah, crypto makes sense as a diversifier. So take on investing in crypto. Yeah, it could definitely be a diversification play. But again, you have to know the asset allocation. You have to know how much you're willing to tolerate. And for that, you probably want to assess your risk tolerance and know where you are financially. So a lot more that goes into once you decide, okay, I'm going to do Bitcoin, then there's a lot more analysis that has to be done. It just doesn't end there.
Yeah, and I wouldn't say make it a large portion of your
Oh no.
portfolio. I mean,
You saw that article that we said that financial advisors are recommending 1% of your portfolio. Some will say 3, some will say 4, but it's in the low single digits, really.
Well, and as that article you sent me, only 14% of those advisors are recommending even to have Bitcoin
Right.
as part of your portfolio.
I think that number is going to go up quite a bit in the
time
next
goes, yeah.
couple of years. Yeah, but for now, yeah. So yeah, I would do for our clients, it's something that we're looking at, but it's going to be low single digits as well.
So
And for me also, not only the inflation, let me just add this. It's not
we're
only
gonna
an
wrap up the show,
inflation
sir.
play.
So make it quick.
Well, hey, we got one comment, so I got to make sure I answer this thing. But
Yes.
but if you could go back, let's say you could go back 10 years, and if I gave you $10,000, Robert, and I sent you back 10 years in time, what investment would you buy?
Shit. Back then, I wasn't investing so much. Probably would have paid off either a credit card, or when.
No, I mean not just to buy an investment.
Oh,
Let's
just to buy an
say
investment.
But are you saying with benefit of hindsight, or you're just saying?
If I mean,
right. If you knew now, if you could go back in time, you got $10,000, you could go back in time, and you knew everything you knew now. What would you buy? What stock would you buy?
I would have bought something that I knew was going to blow up, especially now. I mean, but that's the hard part.
In general, the big ones, the big winners over the last 10 years are basically like the FANGs. So you had like Apple, Google, Amazon, and what did all of those kind of things have in common?
Risk?
They base what's that?
Risk.
Risk. Well, yeah, they did have risk, and you're not going to get tons of gain without risk. But they, like for example, Amazon was just a online book company. Nobody knew that it was going to grow to that. But basically, a lot of what they had in common was they were basically taking things that were in the real world and dematerializing it into the cloud. So if you look at like Amazon took all the books in the library, took the words out of the books, put them in the cloud, and sold books. That's how they made their money. And then they use that money to take all the stores, the Macy's and the Sears and all the things that were in the malls, and then they put them in the sky. And so now you don't have to go down to the mall to get whatever. You can just click it on your phone and it shows up at your door. The same thing with Apple. Apple took people used to have shoe boxes full of photos. Now all those photos are in the sky. They're in the computer, and you can carry them wherever you want. Google took all of if you were going to take a trip, you would have to buy a Rand McNally map and see where you're going.
Which sucked,
Google
by the
took
way.
all of those. Yeah, Google took all of those books and put them all on your phone, and then added traffic. So you just take it for granted. You get in the car, you want to go somewhere you've never been, you just put the address and it tells you exactly where to go. And so that's how Google gets to be $1 trillion company. And Rand McNally is only $1 million company. So that's the difference. And so for me, I don't probably. But anyway, so that's what Bitcoin is doing. But Bitcoin is just taking property and it's taking property, and it's taking value it'll take it from real estate, from stocks, from gold, and just put it in the sky, in the cloud, so that you can carry your investment with you and take it wherever you want, take possession of it. And so
I do
to
agree
me, Bitcoin, I'm sorry. To me, Bitcoin looks very similar to all of those early companies where it had, it had like 50-60% of the market, but yet only 2 or 3% penetration. Like if you ask around, not a lot of people own Bitcoin. And so
Well,
the potential upside for as far as a technology company is a lot greater than it going to zero for me. So to me, they call it an asymmetric bet. So it's like you have 2 kings and the dealer showing 6, and now you can bet whatever you want. Well, you're supposed to bet when you see those kinds of things.
You're not going to hit
Will
on
it
that
work
one?
out every time? Will it work out every time? No, but those are the things that you're supposed to invest. And then, and also I would
split
say
on those.
you would split.
Maybe. Double down.
You're
on
more,
that.
you like more risk.
Well, that's true. And again, going back to Bitcoin, Amanda said Tesla. We should have invested in Tesla. But
like
no,
Tesla
going
also,
back to
yes.
Bitcoin, I think what, and we have to end the show, by the way, but I think what Bitcoin highlights is, again, the volatility and the usage. People don't care about the usage. They just want to see the return. They want to go to Vegas and come back with a story, and they don't know like the logistics behind it, the confusion behind it, because everybody sees the glitz and glamour like Vegas is. And that's what Bitcoin represents to a lot of people. They just want to win. They see all this
You got to
money.
know that it's.
But there's more uses to it. I do agree.
So
yeah, and I'll just say one thing real quick about. Okay, so 30, 40 years from now, when we're kind of nice and old, hopefully we're still kicking. 30, 40 years from now, there's going to be one theme from now until then. Yeah. In 30 years from now until then, when there's going to be one theme that outperforms them all. I don't know if that theme exists already, or is going to exist in 5 years, or it's going to exist in 10 years. I have no idea. Or it's going to exist on year 29, and that 1 year is going to pop. Who knows? I don't know if it's Bitcoin or what. The thing is, if you're diversified, you're going to capture that thing, but just be diversified.
Yeah.
I don't know if it's Bitcoin. Also say, I would say, look, nobody's ever had Bitcoin if they've owned Bitcoin for 4 years, nobody's ever lost money. And so, again, you have to take emotion out of it. If you're going to be into crypto, I would say you buy it and with the time frame that you're going to keep it for 5 to 10 years. And you're not going to be reading the news, because like if you're going to speculate or you're going to be like a trader, then that comes with a lot of anxiety, because then you're constantly reading, oh, okay, now it's gotten banned. Oh, China is banning it. All these, the government's going to come up with it. You're constantly reading and trying to decide what to do. I would say just take the emotion out of it. Take some money take a portion of your money and invest it, and then just leave it there, and then see what happens.
And if you want a water cooler story, just go to Vegas. That's really all it comes down to. So we're coming to the end of the show. So I want to thank everybody for joining us. Satoshi, thank you, sir, from Sacramento. Senor Francisco Ayala from the Coleridge Group. He's here and available for you if you want to contact him on the side. His email is down below. Satoshi, you're going to have to find him on Facebook somewhere. I got his number, but he's got to give it to you to get to you. So Rob Morales, RCO Network, I want to thank everybody for joining in. Thank you for the comments. We'll catch you guys here every noon hour on Fridays. Say sayonara.
Bye-bye.
See you guys later.
See you later.